and the landscape around revenue and revenue options. And Gail, are we, oh, we are live. Okay, excellent.
So we just had that question, is there a way to tell by looking at the screen when we're live and when we're not live? I know in our legislative committees, there usually is, but
If the teleprompter is working, we are live.
no, we've been told that that's not true.
Okay, because that's what I assumed and turned out to be true.
Okay,
And as soon as it was turned off, the teleprompter stopped.
No, I can do it either or.
Okay, well,
Or
good.
transcript, yeah.
But I will certainly remember, because I tended to remember in my own committee room, we need to go off live before.
yes. So maybe we should just check and make sure we're offline before we start yakking and taking breaks and stuff. So sorry about that. Okay.
Thank you for having me today. This is my first time being back in the State House and speaking to a group of people. So it's there might be a little bit of rust at the beginning, but hopefully it shakes off. My name is Graham Campbell. I'm a senior fiscal analyst at the Joint Fiscal Office. I am the person in our office primarily who looks at non-property, non-transportation tax revenues. So no diesel taxes, no gasoline taxes, no property taxes, but everything else kind of fits under my jurisdiction. So if you have questions about those taxes, transportation is Chris, property is Mark Peralt, but everything else is me. So I guess I'm here to maybe bring a little bit more of an uplifting presentation than what Steve just finished out on. And that's kind of the way it works. Me and Steve, it's kind of a compact top situation. My presentation is going to be, a lot of it's going to be informative, just essentially very basic tax things. How do taxes work in the state? And then I'm also going to be talking about, revenue options, who pays the taxes that we talk about, especially some of the big ones. And I'm happy to take questions throughout the entire presentation, but you'll be seeing a lot of basic terms that some of you may know, some of you may not know, but I think it's, in my experience, it's helpful for people who don't necessarily live in tax world all the time to sort of see some of these things before, we start getting into the weeds. So without much further ado, so sort of talked about this just now, but the way this is going to work is I imagine it, and I've given sort of a similar presentation like this before, is think about one of those bus tours you see in the big cities where people are sitting on the roof and they're looking at the various sites. That's how this is going to sort of work, where we're going to do quick stops at some of the big taxes, the major landmarks, I call them, personal income tax, sales tax, and the corporate income tax. But we're not necessarily going to dive deep into the full-on concepts. I'm happy to take questions on those if you have them, but we're not going to get into, really, really deep corporate income taxation stuff today. And then we're going to, after you do those three major landmarks, I'm going to look at some other revenue types quickly and talk about some potential revenue options that Chris relayed to me that this task force has discussed, and talk about some of the issues there. And then I'm going to wrap up with what we call tax expenditures, or sort of things that artificially lower the amount of money that we collect through policy choices, or just general, favoritism toward one particular group or thing. So the first stop on this bus tour is going to be at tax school. So this is the basic part of this presentation that we're going to quickly touch upon before we get into the nitty-gritty stuff. So basically, when you think about taxes, everything comes down to this basic equation of three parts: the tax base times the rate equals the liability. Two parts on the left side of this equation, and then the liability on the other side. So the basic part that I want to portray from this this equation is that the bigger the base, the lower the rate you can have to raise a certain amount of revenue, or you can have a high rate and a small base to raise a certain amount of revenue. So basically, everything that I'm talking about today, you're going to hear about rates. You're going to hear about the tax base. Tax rates and tax base are two distinctly different things. And if you want to raise revenue, you can either increase the size of the base, or you can increase the rate base. That's more or less what I want to portray here. So beginning on the left side of that equation, on the next slide now, the tax base is generally defined as what is included in the statutory language minus any exemptions, deductions. So let's talk about the sales tax as an example. The tax base for the sales tax is what's called tangible personal property. And tangible personal property is sort of a fancy term for goods, more or less. So, things that you can touch and hold are included as part of the base. The value of that sort of tangible personal property is the tax base, minus any exemptions and deductions from that base. So I have this little sort of handy pie chart here that sort of shows you the tax base if we tax everything, and then exemptions and deductions. Now, that's distinct from things like, so if we think about the tax base for the sales tax, tangible personal property is the base. But something like services is not considered a deduction or an exemption. It's just not part of the tax base. It's not tangible personal property. It's not part of the definition. Another example would be in income taxes. We don't consider things like housing wealth to be part of the personal income tax, because income is defined in statute as, capital gains, wages, salaries, pensions, things like that. Housing wealth is not one of those. So we're not necessarily excluding housing wealth from the personal income tax. It's just not part of the tax base. So touching upon that theme a little more, an exemption is sort of a systematic exclusion from the tax. It is usually limited to a particular group of taxpayers. So the example I have here is the property tax, right? The property tax, the base is the value of all property in the state, commercial, residential, and otherwise. But most libraries are statutorily exempt from paying the tax, even if their property would otherwise be taxable. So we have a line in statute that says libraries are not part of the tax base, and that's an exemption we're pulling out of the base, and therefore reducing our base, reducing our revenue, if you think back to that equation. So most exemptions can be full or they can be partial. So full exemptions obviously cost more. We go back to the library exemption. We exempt all libraries from the sales tax. We don't say, in a version of a partial exemption, we don't say if the value of the library is over 500,000, then it has to pay tax or something like that. Another example of a partial exemption would be in Vermont in income tax, we exempt a portion of Social Security income, but not all of it, depending upon your income. So that is different from a deduction, which is the amount that an individual is taxpayer themselves is permitted to subtract from their tax base. So a good example of this is if you think about your personal income tax, your base is your income that you made that year, but you can deduct certain things from that income. So an example of that would be if you, on your federal taxes, you were itemizing your deduction, you're allowed to deduct your mortgage interest that you paid that year. And that lowers your income, lowering your base and lowering the liability that you have to pay. So for the individual, it lowers the liability. From the state's perspective, that costs us money. So there's a difference between exemption and deduction. Deduction is typically something we talk about at the individual level, not on sort of a wide scale policy level. So the second part of that equation is tax rates. So they can be fixed or they can be tiered. Sales taxes is 6% in Vermont. It is applied uniformly across all tangible personal property, minus the exemptions that we have. It's one rate. Vermont's income taxes are an example of tiered rates. So typically in a tiered rate structure, you have a series of brackets with whatever is the tax base going through those brackets. And most tier brackets are structured in a way to be progressive so that the tax liability for the individual increases as you have more and more tax base to be taxed. So that's the classic part of the personal income tax, the marginal tax bracket structure. And the taxpayer only pays the assigned rate for each dollar within that tax bracket. So I'm going to explain how that works. So you will often hear in sort of tax policy two different terms: the marginal tax rate and the effective tax rate. These are extremely important terms for talking about it. And quite frankly, the more important one to think about is the effective tax rate. But I'll start with the marginal tax rate. So we have this example here of a tax bracket. You see that 0 to 10,000 is 5% rate, $10,001 to 100,000 pays 10%, 100,000 to $1 million pays 15, $1 million plus pays 20%. So if you hear about someone saying, what is your marginal tax bracket, tax rate? What we're talking about here is the tax rate paid on the last dollar in that on your income. So if someone here, the example, makes $20,000 in income, they go through that first bracket, that 5% bracket, but what ends up happening is that $20,000 falls into that second bracket. And so their marginal tax rate, the last dollar of the 20,000 is paying 10%. So their marginal rate is 10%. So what you'll hear a lot, particularly from more people who want to sort of make the tax system seem harsher than it is they'll say, you know, Vermont has the highest tax rate in the country. Its top rate is 8.75%. That's sort of saying that that is the highest marginal rate you can pay on the highest dollar in Vermont. If you're, you know, have a very high income, that's what you're going to be paying on that last dollar. But for the vast majority of taxpayers, that is not, they're not paying 8.75 on the entirety of their income. What is more, I think, instructive for policymakers is to look at the effective tax rate. And that's the actual rate of tax liability for the entire, actual rate of tax for the entire liability. So an equation there is basically how much tax liability you have over how much total base you have. So in the income tax, how much tax are you paying after you calculate your tax over how much income you have? And that's the effective tax rate. So if we look at the taxpayer with 20,000 in income, the first 10,000 is going to be taxed at 5% based upon that bracket. So they're going to pay $500 on that first 10,000. And then because they have 20,000, they're bumping into that second bracket. And so they're going to pay 10% on that next 10,000. So $1,000 in that next 10,000. So overall, they're paying $1,500 in taxes in this hypothetical example. They have $20,000 of income. That's the denominator here. They're paying an effective tax rate of 7.5%. So essentially saying they're paying 7.5% of their income in taxes. That's, you know, when I talk about personal income tax and lots of other taxes, I almost always refer to the effective rates that people pay. But you will hear people talk about what is the highest, well, you know, what's the highest tax rate, what's the marginal tax rate in a various state. But what really matters is how much people are paying as a percentage of their income throughout the income distribution. So once we calculate the liability, we have things that reduce that liability. So we're on that right side of the equation right now. Tax rate times base equals liability. So we're on the liability side now. So something that can reduce liability is credit. So credits always reduce liability. They don't reduce the tax base like a deduction or an exemption. But a credit is an amount that reduces the tax liability. It does not reduce, as I said. Credits can either be refundable or non-refundable. So a refundable credit means that a taxpayer receives a payment from the state if the credit reduces their liability to below zero. So imagine you had someone with a $100 tax liability, but $150 refundable credit. What that means is that the $150 credit will wipe out that tax liability, but then the state or federal government or whoever's the taxing authority will issue a payment to that person of $50. Versus a non-refundable credit, which can reduce the liability to zero, but not any further. So in that same example, if the $150 is a non-refundable credit, we're going to have a zero liability, but it's not going to, no one's going to be getting a payment from the state. They might be able to carry forward that unused credit, that $50 in future tax years, depending on the credit. But generally, you're not paying the person if they have more credit than liability. So examples of that, refundable credit, the biggest one in Vermont is the earned income tax credit. And in fact, the state issues payments to a very large number of taxpayers, about 45,000 taxpayers, tax returns in Vermont receive a payment from the state largely because of the earned income tax credit, because that is a refundable credit, drive your liability to zero. And then, you know, if you have more credit than tax liability, you'll get a payment. An example of a non-refundable credit is we have a charitable tax credit in Vermont. So you get 5% credit for up to $20,000 of contributions, but that can only wipe out your liability to zero. It can't, you know, you're not gonna be getting a payment from the state after that. So that's the end of tax school. Does anyone have any questions before we start to get into the nitty gritty?
Did we all pass?
You all are shaking your heads, so up and down, or nodding your heads rather, I should say. So the rest of this briefing is basically we're going to go through tax types, and we're going to talk about what is it, how much do we collect, who pays it, and then just what's new, you know, what's interesting stuff going on here, and how has COVID-19 affected this revenue stream? And I'll sort of, we're going to have new information tomorrow based upon Tom's forecast. I'll maybe highlight a little bit in the direction, but basically what I'm telling you now is might be a little bit outdated, but the general trends I think will be sort of be continuing. So the first place we're going to start is the personal income tax. This page here essentially shows you the US 1040, the federal 1040. That's the US standard personal income tax form, the Vermont IN 111, and which is the Vermont equivalent. So maybe ask me why am I showing you tax forms? And the reason that is because I think it's instructive to sort of show what the base here is in Vermont. So the way it works in Vermont is we grab items off of the federal return as the sort of starting place for Vermont's personal income tax. So if you look at this 1040 with the red boxes highlighted here, you can see that the first things you fill out are your wages and salaries, your tax exempt interest, your qualified dividends, your IRAs, your social security payments, capital gains, and then other income. That is the base, the starting place for the personal income tax. And it all starts on the federal return. You put down a number there of the sum of those things. And that essentially becomes what Vermont picks up. The second small box there is the adjusted gross income. Adjusted gross income more or less tracks the sum of everyone's individual pieces of income, but there are some adjustments that are made after that. So for instance, if you're a teacher, you can take educator expense deduction prior to adjusted gross income. So you calculate your income, take some small deductions, and then your adjusted gross income will likely be smaller than your total income. But the big ones that you hear about, the charitable deduction, mortgage interest, the medical deduction, those are itemized deductions on the federal return. Those are after adjusted gross income. So in tax world, generally, we consider adjusted gross income to be the best measure or a very good measure of people's income or ability to pay. So you'll see charts in the later part of the presentation that are broken out by adjusted gross income group. But adjusted gross income is a very important term because it is the starting place for Vermont's income taxes. You can see here on this sort of flow chart, you have a blue box, the adjusted gross income box, which comes off in the federal 1040. And then basically we're all on Vermont's forms. What Vermont says is it says, okay, take your adjusted gross income and make some subtractions from that. So first thing that you do is you take a standard deduction, which is more or less an adjustment for the type of filer that you are. So you can deduct $6,250, this is tax year 20, if you're a single filer, or $12,500 for a married filer. You also subtract $4,350 for you, your spouse, and any dependent as a personal exemption. And then there are other subtractions that Vermont puts into its tax codes. The big ones here are the capital gains exclusion. So if you make capital gains income, you can either subtract $5,000 or 40% of the capital gain if it's from the sale of an investment property, a business, or farm and timberland. Things like stocks and bonds are not eligible for the 40%, but they are eligible for the $5,000. The Social Security exemption is a full exemption of Social Security benefits up to, I need to remember this, I think it's $40,000 of AGI, adjusted gross income, for single filers, and $55,000 for married couples. So you're taking your adjusted gross income, you're subtracting these items, and then we make you add back some certain things here. And for the majority of Vermont taxpayers, they're not adding back very much. So Vermont state and local bonds, that's exempt at the federal level, but we don't want to give people a double dip on Vermont. So that's why we sort of make them add it back. And you come up with this term called Vermont taxable income. And that is the measure that gets put through the brackets. So what I want to portray here is that when you hear someone say, I make $85,000 a year, what you don't want to do is say, okay, 85,000, and then look at the brackets, because that is not what gets put through the brackets. What gets put through the brackets is your taxable income, which is after your standard deduction, after your personal exemption, after any other subtraction. So the Vermont taxable income is almost always lower than adjusted gross income for all taxpayers. So Vermont taxable income gets put through the brackets, as we've talked about. And basically here at the single and married filing jointly brackets for Vermont has 4 tax brackets. Even though it looks like 5 here, just this is from the Vermont Department of Taxes. They help you calculate how much you owe if you have taxable income under $75,000. But it's 4 brackets with rates of 3.35 up to $67,450 for a married couple and $40,350 for a single individual. So again, if you think about those taxable income brackets, these people's actual income is probably closer, in that bottom bracket, probably closer to something like $85,000, depending upon the size of their family, how they're filing. for a married couple, and then for the single filer, probably somewhere around 50,000 is probably what you in actual income. So 3.35, and then it goes up to 6.6%, 7.6%, and then 8.75 for the highest bracket. And so you'll notice there that you have sort of a lot of income at the bottom bracket, and then after that it starts to pick up quite quickly. That's a I think relatively unique trait about Vermont's personal income tax structure. Is it sort of is quite low rates in a lot of individuals, and then once you start to make higher incomes, it picks up pretty quickly. And I'll show you a graph to illustrate that. So after you put your income into the brackets, you come up with your initial Vermont tax liability. And then once you come up with your tax liability, then it's a matter of looking at your credits. So you have your non-refundable credits, the big one there being the charitable tax credit, but there's also a non-refundable credit based upon the federal child and dependent care credit. Then the refundable credits are, the biggest one is by far the earned income tax credit. And so that reduces your liability. And the final step of all this, and this is a key point, is the Vermont apportionment percentage. So for the vast majority of Vermont resident taxpayers, that apportionment is going to be 100%. The amount of income that is Vermont-based is going to be 100%. If you earn wages in Vermont, the only source, and that's the only source of your income, it's 100%. But for high-income taxpayers, that number changes a lot. One of the examples the Department of Taxes often gives is Oprah. Oprah might make $1 billion in a given year. Let's say she comes to Vermont and makes $100,000 speaking at a book event. Oprah's going to file a Vermont tax return, and she's going to post her adjusted gross income saying my income's $1 billion. But what she's actually going to be taxed on is $100,000, because that was the Vermont-based portion of this. So for a lot of high-income taxpayers, you will see apportionment percentages kind of all over the map, particularly those who are, and this has become a bigger issue nowadays with remote working, right? What does that Vermont apportionment percentage become if you're, working for a Boston-based employer, but you're working in Vermont, right? Some states have interpreted that to say, well, no, that's Boston-based income. Like Massachusetts is basically saying, if you're working in Vermont and you're working for a Boston-based employer, that's Massachusetts income. But Vermont says if you're living and working in Vermont, doesn't matter where your business is, that's Vermont-based income. So that's more or less how we calculate Vermont personal income taxes. That's sort of the what is it question of this briefing. So personal income tax, how much do we collect? We've eclipsed the 1 billion mark on personal income taxes in fiscal year 21. And this blue line here shows you what it's been like since 2005, not adjusted for inflation. But this is sort of what we've collected. That dashed line is the January 2021 forecast. We're getting a new one tomorrow. But to give you an idea of how good of a year personal income tax it was, that triangle tells you how much we've sort of beaten the forecast in fiscal year 21. So we beat the forecast by $124 million in fiscal year 21. And right now, the personal income tax represents about 60% of available general fund revenue. So it is by far the biggest fish in the general fund. It's available for all the spending that Steve has talked about. So we really watch the personal income tax a lot. And that number is growing over time. As you can see, it was something like 48% back in 2005. Yeah, now it's 60%. And then I think my conversation with Tom Cabet have sort of said that that's going to keep growing because personal income taxes are a bigger share. Yes.
So what went into that large increase then, that 124 million above forecast? What were the factors that created that?
Yeah, so I think the biggest thing, I think the broad explanation that Tom Cabet would say, that he's relayed to me, is just the amount of federal money that is poured into the economy has just shaken out in so many different ways. So a good example is with wage earners who lost their job during the tax year 2020. So tax years January to December. They were receiving bonus unemployment insurance. So oftentimes they were making more money than they were when they were employed. So what we saw during last year and this year is that the largest withholding account, basically for taxes. So when you work, your taxes are withheld by the Department of Taxes. The largest withholding account of the Department of Taxes was the Vermont Department of Labor, which basically means they were the biggest wage taxpayer in the state past, for at least certainly during 2019, but into 2020. So what we saw there was we saw higher withholding numbers within the personal income tax, which means that they were beating what we thought they were going to do. Another thing that we saw a lot of, and I'll touch upon that, and I think 2 slides down, is what we call estimated payments in the personal income tax. So if you have a business and you're paying to the personal income tax, you have big capital gains, you have rental income. The IRS requires you, if you have a certain amount of it, to pay your taxes quarterly. And so those are what we call estimated payments. And those estimated payments were significantly higher than we thought. So what that tells us initially, we don't have the data yet, but that sort of hints at very strong business income in tax year 2020 and very high capital gains in tax year 2020. And, you know, that's sort of backed up by things like the market. We know the asset prices are very high right now. And so a lot of that is federally driven. So you have, you know, you might imagine a company that sells home improvement stuff. Those companies did quite well during the recession. You know, they might have ended up with very large tax liability at the end of the year, personal income tax. You know, you think about how monetary policy, the Federal Reserve, that lowers interest rates, has inflated asset prices, large capital gains, that shows up. So I think the early explanations point to things like business income, capital gains, which are pretty much exclusively high income taxpayers. Another thing that we sort of thought about is new people moving into Vermont. There's just not enough data there to tell us whether this is new people. So I think the biggest thing we would say is business income, capital gains, and then federal stimulus, which is driving things like bonus unemployment. Usually,
I think the key too is that it's not adjusted for inflation. So as incomes and other prices have inflated, you know, it may look like it's bigger, but the real purchasing power of that 124 million might not be what it was
that's
a year or two ago.
totally true. Yeah. I would say over this time period, particularly post-recession, inflation's been like 1-2%. So, I mean, we could adjust this for inflation, but I think you'd still see record levels of income tax coming in. But, you know, for the state purposes, that what we really matter is what the actual dollars that flow into the treasury. So, yeah, it's a good point to think about the actual buying power, particularly if we're investing in so many things. If there's a lot of inflation in, say, construction, then that, you know, drives down the value we can get for our dollar spent.
I don't want to spoil what comes out tomorrow, but do you have a sense of whether this period in the triangle is going to represent an outlier, or is it going to be more of a base where revenues continue to grow from? You know, is the trend going to come back towards that line, or is it going to continue from that triangle?
My conversation with Tom talked about this sort of being a level shift, but what Steve talked about is even once you have that level shift, he's looking at like 2.5%. So you might have this one up and then 2.5, you know? So I wouldn't say expect a ton, you know, a bunch of positive surprises in the future. It looks like, you know, we are in right now, at least in a very good time for personal income tax, but the actual growth every year looks like, as Steve mentioned, about 2.5%. So I would describe it, at least what Steve's told me, what Tom's told me, is more of a level shift, sort of like up and then up slowly, but not like a up.
The base may shift. The base will probably shift, but the trajectory won't continue.
Correct. But I would say also this is something I touch on later, and this is a volatile income source, particularly if you're becoming more and more reliant on high income taxpayers. So, you know, the out forecast might be something like 2.5%, but if, you know, just as we beat the forecast by $124 million, which is, you know, about 10-15%, you know, in a given year in the recession, we were off by 10-15% in the other direction, right? Again, sort of hinting at what I'm going to talk about later, is that as you become more and more progressive as an income tax, the more and more sensitive you are to those things, because the income of very high income taxpayers is really driven by things like capital gains, which come and go in a given year. And that's why it's so hard to predict oftentimes personal income tax, because the more and more reliant on things that are unpredictable, like capital gains, the more and more you're going to miss your forecast in either direction. So, and it could just be things like, you know, not just, you know, a bad year for capital gains, but things like, let's say the Feds say they're going to impose higher capital gains rates next year. What people do is they start realizing all of a sudden this year, and you get a huge wave of capital gains. You're like, wow, we're doing great. And the next year they're off a cliff, right? Because no one realizing in the high tax rate regime. So these things are very sensitive to federal policy, economic conditions, and they're increasingly more difficult to predict. So, and this kind of highlights this next page with bar graphs. So this is kind of I wouldn't call it my best chart, but I tried to convey a lot of information here. But the blue bars show you how many millions of dollars of personal income tax we collect from each one of these adjusted gross income groups. So you can see, we have the income groups on the bottom and how many millions of dollars we collect. And then on top of those bars, that represents the percentage of returns in that group. So if we look at the far left, 31% of our tax returns have negative or $25,000 less in adjusted gross income. But they represent a negative portion of our Vermont income tax, which means that we are, for a huge portion of those, they are in aggregate, we're issuing payments to them, to the 31% of our total tax returns. And then if you go on the far end, you see that we collected, roughly $300 million from 2% of total tax returns. 2% corresponds to just under $300,000 in AGI, about 300,000. And but that's about 36% of our total income taxes comes from 2% of our taxpayer population. So these numbers, I've been updating this chart since I've been here 5 years. These numbers become smaller at the bottom end and become bigger. Some of that is due to inflation. So, more and more people are just gonna be making more money over time. So more and more people are gonna end up in these higher brackets. But there is definitely been a shift beyond inflation towards more high income taxpayers paying more burden in Vermont on personal income tax. Yes.
Do you have the numbers of how many people fall into each of these ranges here?
I don't have the numbers off the top of my head. We have about 330,000 tax returns. So 30% of 30,000 or 330,000 is, 40, 50,000 tax returns. These are tax returns, not people. Sometimes it won't even represent a household. You might have, people filing separately. Generally, we're all talking tax returns here.
Okay. Yeah. And you said that was 330,000 roughly.
Resident returns. Yeah, and that's what this is based upon.
Do you know how these numbers compare to other states or to the feds?
I don't know to the feds. Hopefully one of my other charts will help illuminate that a bit. 2 down, I'll show you how that compares to other states. I think in general, the thing I would say is Vermont's is probably the most progressive in New England. And New England already has a relatively progressive type of income tax system as a whole across all the states, with the exception of New Hampshire. They don't have an income tax. But yeah, Vermont's, as I talked earlier, is low for a huge number of taxpayers. But once you sort of hit about 100,000, then it starts to get pretty steep. I'll show that in 2 slides. But this is kind of what that talks about, this slide here. This is the effective tax rate for Vermont taxpayers in all of these income groups. So this tells you essentially what is the share of their income that they're paying in personal income taxes. And you can see in aggregate, for those with under 25,000 adjusted gross income, in general, we are issuing payments to them of about 1 to 1.25% of their income. So roughly, the average earning income tax credit's about $600, $700. So that's a major poverty fighting tool in Vermont. It's one of the most generous in the country. That you can see, as you sort of make your way up in the income distribution, people are paying more and more of their income in personal income tax. And at about 100,000, you can see the line gets a lot steeper. And that's the structure of the income tax brackets and the nature of what deductions we allow for high income taxpayers. So in this middle group, the value of those deductions is quite high. It wipes out a good chunk of their income. For high income taxpayers, $12,000 standard deduction if you're making $300,000 is pretty much worthless in the grand scheme of things. So you see that steepness after $100,000. And so by the top, you're paying about 6.4%. I get a lot of questions about why that dips at the end. The reason that is the capital gains exclusion. People with $1 million in AGI often have large capital gains. And because we give that group a 40% exclusion, you see that dip. And so I would emphasize that those people are not just earning capital gains every single year. I would say that a good chunk of them are people who make normal AGI in a given year. They sell their business, they sell their farm,
which is their pension or retirement.
Which they might be using as an asset for retirement. And they make but the problem is the way income works is that gets counted as income. So one year you might have 90,000, next year you have 1.25 million. And that's one of the policy reasons behind giving a 40% exclusion for that group.
So because of these capital gain deductions, do you have and I know you said they're hard to account for in a given year, do you have a general sense of how much potential revenue we miss out on
Yes.
from not collecting on those?
So the cost of that tax expenditure runs between $15 and $20 million a year. So we know that for a fact. A couple of years ago, I did a study on the capital gains exclusion about people who take it, who takes it. The vast majority of the dollars of that 15 to 20 million comes from high income taxpayers. Like 90% of it comes from high income taxpayers. And what we found is that, you might still, one of the reasons this was put in place is for those one-time events for normal taxpayers. But what we found was that it is often taken more than once from people. So I think something like half of the people who had taken the capital gains exclusion over the prior 5 years have taken it more than once. So we're not talking about a one-time sale on asset. It might be 2 times, but people definitely take it more than once. And it's definitely not farm sales is one thing we ruled out. The total amount of the exclusion, only about less than 4% of the dollars were from returns that had any farm income whatsoever. So, either people are, my guess on the capital gains exclusion, we can talk about it more in detail, is that a lot of it is investment property and business sales. But that's why you see that dip. And I would mention that dip, we have scaled back the capital gains exclusion. We did it in 2018 or 19. That dip has gotten smaller. So it used to be like a dip from 6.4 to about the high 5s. Now it's pretty close back up to 6.4. So, yeah.
You answered 2 of my questions, which was why does that dip? And then also, is it really all, one-time family farm, or are there other expenses? It seems like mostly other. Is that report that you did on the capital gains exclusion, is that publicly available?
Yep. Yeah, it is. It's part of the 2019 tax expenditure report, and I can send it to Gail, who can distribute it.
Thank you. That'd be great to take a look at.
So the moral of this chart is that basically we have a quite progressive tax system already in place. And this next chart shows you how that compares to New England as a whole. So this was data from our 2017 tax study report. We do a big overview of the tax system every 10 years. We're statutorily required to do so. And this is from 2013 and 14. So a little bit outdated, but it shows you how effective tax rates go through the income distribution for New England. So you can see in Vermont, if you have AGI below 100,000, which is about 85% of tax returns, you have on average the lowest personal income tax burden in the state. It's only after that 100,000 you can see that steep incline, such that by the time you're a $500,000 million taxpayer, you're sort of amongst the sort of New England average. But you can see also that dip was a lot sharper in 2013-14 than it is nowadays. And that's because we've scaled back that capital gains exclusion. And we sort of changed our tax system as a whole, which I'll sort of touch upon on the couple slides from you now. So, yeah.
So even though this is from 2013, 2014, is it still pretty similar?
Yeah. I can't speak to, so basically no state in New England has increased their taxes under 100,000. So what you might see is some more steepness from other states, but I'm trying to think about the states that I follow. Maybe Connecticut has done something, but I can't think of any other states that drastically increased their taxes on high income taxpayers such that they would, outshine us or, make this chart any different significantly.
So I can't remember where it came from, but a few years ago when we were looking at some tax policies, Vermont was ranked 5th in the nation, I think, for progressive tax rates.
Yeah, I've seen a report on that. So the Institute for Taxation and Economic Policy, sort of I'd call it more a left-leaning think tank in Washington. They produced this report called Who Pays, and it covers all taxes. And what they essentially do is they try to estimate the effective tax rate for taxpayers across all the income distribution, accounting for not just personal income tax, but sales taxes and property taxes, everything like that. And what they found is that our system largely because of the personal income tax and what we exempt in our sales tax, was the second most progressive state in the country. States that rely heavily on sales taxes on the hand were, and property taxes were sort of called very regressive states. So does everyone know what those terms mean, progressive and regressive? Basically, your progressive system, the share of your income paid in taxes is higher. So certain taxes, the way you structure them, can be more progressive, and that's what this, our income tax system is. So what's new in the personal income tax? So we've touched a little bit on this, but back in 2018, you'll recall the Trump administration had a huge federal tax reform that they put in place. And that sort of necessitated a major change at the Vermont level, because prior to that, Vermont's tax system was more intricately linked with the federal system. So we didn't start with adjusted gross income, we started with federal taxable income. And that's a big deal because we were essentially picking up all the federal deductions like mortgage interest and the charitable deduction, things like that. We were picking up the federal personal exemption, which got wiped out in the tax reform. So what, in preliminary modeling of how that was going to affect us, what we found was that even though the federal government lowered their taxes a lot at the federal level, the sort of getting rid of deductions that they did at the federal level was actually going to cause taxes in Vermont to go up for taxpayers, particularly for families, because that personal exemption that they wiped out. So we found that in aggregate, about $30 million of extra tax liability was going to accrue to Vermonters. And I think in one of the sort of more inspiring things in my time at the legislature, there was a real bipartisan effort to sort of turn things back to the way they were. So the tax department and the administration put together a tax proposal, which its goal was to essentially keep people the same as they were. It came to the legislature, and the legislature made some minor tweaks to make the system slightly more progressive, but by and large, we decoupled completely from the federal code. So the only place that we really link up heavily in the federal code is adjusted gross income. No longer are we picking up all these federal deductions and stuff like that. And we boosted some of our existing progressivity. So one of the things we did was we made the earned income tax credit slightly larger in that change. We did no longer allow a charitable deduction that carried through from the federal, but we allowed for a charitable tax credit of 5%, which was available to everyone. So people at the lower ends who gave to charity would get some benefit. But the part that made it more progressive is we capped the amount available for that credit at $20,000 contributions. So a lot of high income taxpayers give a lot of money to charity. And so that sort of cap ended up being sort of a tax increase for them. So modestly more progressive at the end of that 2018. Another change that we made that's not on this slide was the scale back of capital gains exclusion, which took place in 2019. Used to be that 40% exclusion was available unlimitedly. So you could have $10 million of gains and we give you 40%. Now the maximum exclusion you can have on the capital gains exclusion is $350,000. After that, there's no more. So that's why you see for those really high income taxpayers, that sort of tick back up in their progressivity, or tick back up in terms of their tax liability. And we've touched a little bit on this. So how has COVID-19 affected this? So we've seen record personal income tax payments, but particularly in estimated tax payments since basically March 2020, since the pandemic began, they've smashed record. And this, we think, is sort of a reflection of this K-shaped recovery that everyone's been talking about, where you have a lot of people sort of staying flatline and then some people doing really well. So strong business income, capital gains, the bonus unemployment also likely boosted withholding payments a lot. And then we've talked a little bit about people moving to Vermont and working remotely. That we think that's primarily a high income taxpayer type of situation, but we don't have the data yet to say whether that's a big deal. And quite frankly, I don't think that that's going to be a big thing unless they are really wealthy and they're working in Vermont, because the numbers that we're seeing in school districts are just not big enough to indicate 2,000 high income taxpayers coming to the state. But say if even just 15, because we're such a small state, 15 really high income taxpayers move here, that can move the needle quite a bit on personal income tax. So we'll be watching that more closely. And this chart essentially shows that personal income taxes are doing really well. They are above their pre-pandemic forecast. So even before the pandemic happened, we had a forecast and now we think that we are well above that. As you can see with that red line. That's the sale, that's the personal income tax. Any questions before sales tax? Yeah.
Just before we move on to a new topic, so how did the Trump tax changes in 2017 impact people in Vermont, and kind of reducing their federal liability or not reducing their federal liability?
Yeah, in general, most Vermont, almost beyond 90% of Vermont taxpayers received a federal tax cut, and it was say more aggressive in nature. I have some information that I've done on that. But by and large, higher income taxpayers saved, depending on the taxpayer, somewhere between $20,000, $30,000 in federal taxes a year. But at a certain point, because Vermont is a relatively high tax state, the cap on your ability to deduct state and local taxes is really biting on really high income taxpayers. So what you see in Vermont is, everyone received a tax cut somewhere between 1% and 2% of their income. That grows as you go up through the income distribution. But as you get to really high incomes, the people who got a tax cut are much smaller. The total amount of tax cut they receive is a lot smaller. And that's because state and local taxes and property taxes are higher here. And that was something they were able to deduct previously with the federal tax cuts. But now it's capped at $10,000. So they didn't actually receive much of a tax credit in Vermont because of the nature of our tax system. But by and large, I think ITEP put the total amount of tax cuts saved in Vermont, I think something like $250 million for people over 100,000. My analysis of looking at the difference in tax paid between 2017 and 18, when in fact it was not that large, but it was still significant. But you have to remember that federal taxes are always, significantly larger than Vermont taxes. Federal tax rates, the highest level are like 37%. They're like 8% here. So you're talking an order of 4 or 5 larger. And so you would expect those numbers to be significantly larger. And so, yeah, in general, anytime there's a federal tax move, then the dollars that we talk about are just so much higher. So, yeah, but I would say overall, everyone got a tax cut. Not everyone, but the vast majority got a tax cut, some more than others. So the sales and use tax. What is it? 6% on the retail sales of tangible personal property unless exempt by law. Tangible personal property, meaning goods, more or less.
Graham, before you go on, I think Eric had one more question on income tax.
I was just thinking about that discussion and it made me wonder, have we, so there was the federal tax changes and then Vermont made some tax changes in response to that. Do we know the net of that?
The goal in Vermont, so on Vermont taxpayers,
Yeah.
on the Vermont taxpayer, the change that Vermont made in the federal.
Yes.
Vermont's tax change was more or less designed to be revenue neutral or not affect taxpayers. So some taxpayers ended up paying a little bit more in Vermont taxes. Some ended up paying a little bit less, but it was really close. I think after all those changes, the bottom line was about $2 million. So it was not designed to raise money. So it was designed to keep people's taxes the same as they were before in Vermont terms. Federal side, we know that people received very large tax credit, tax cut. That was the goal of the administration at the time. So I would say they succeeded in Vermont and they succeeded elsewhere. And all the analysis I've seen on it is that state by state, pretty much everyone got a tax cut.
That answers my question. So we'd expect those tax cuts to have fallen through essentially completely in aggregate. Different for each, per taxpayer.
Yes, that's one thing you'll hear me talk about. It really depends on the taxpayer, but in aggregate, on average, we see big tax cuts at the federal level. On federal tax liabilities in Vermont after the change in 2018, it was designed to be revenue neutral. So people were sort of kept the same as they were.
Thank you.
Y'all asked me really good questions. So it's a sales tax, a destination-based tax. So it's applied to where the buyer takes possession of the item or where it's delivered. That's kind of a key thing in sales taxes. So it's not don't say a contractor, buys from a distributor. He does not pay the sales tax there. It's the person who buys from the contractor who pays the sales tax. Final destination based. It does not apply to most services. Very key point. You go to the doctor's office, you go to the dentist, you go to pay a lawyer, accountant, none of that pays the sales tax. The only services that we tax in Vermont are small things, boot rental for ski rentals, trying to think of another one. Some laundry, I think, pays the sales tax. So, and that is not exclusive to Vermont. That is a US-wide phenomenon. There are, I think, 2 states, New Mexico, I think Hawaii, tax a good amount of services in theirs. That is US unique. Almost every country with a modern tax system has a tax applied to everything. So yeah, there's been, that's sort of one of the big topics in tax world is change from good to services in the economy, pre-pandemic, I should say. But most state taxes aren't touching that stuff. The revenues beginning in 2019 are exclusive to the education fund. So I get a lot of requests from legislators saying, I want to end the exemption for this, or I want to tax this. And then I say, okay, and then you're just going to be effectively lowering property tax rates. And they say, well, I didn't want to redirect it so we can pay for this in the general fund. So keep in mind that if you do anything on the sales tax, you know, it's education fund specific. You're taking money that would otherwise go to the property tax, to schools and moving it out. But there are exemptions aplenty within the sales tax from the base. So here's how much we collect. We collect about, so in fiscal year 21, we collected about $500 million. So this is a revenue stream that really popped during the COVID recession. You can see we collected roughly over $400 million. And in fiscal year 21, we shoot right up to about $500 million. And that's because people are staying at home. They have a lot of extra money in their pocket from, you know, federal government. What are you going to spend your money on? Fixing your home, getting a new work from home setup, gardening, things like that. All that stuff pays sales tax. So we'll hit on that a little bit more. So who pays the sales tax? Again, I touched upon this. It's remitted by the retailer, but it is actually paid by the consumer. Point I want to remember. You will have a lot of times businesses will come in and they'll say, I don't, you know, we can't change the sales tax because I don't want to pay it. But it's actually the consumer who pays the tax. The business actually just collects it, remits it. Some businesses might, you know, just charge a flat rate and then just take it off the top of the markup. Everyone does this differently, but it is the consumer who pays the sales tax, and businesses hold it as what is called a trust tax. They hold it onto it and they remit it on the part of on the trust of the state. And generally sales tax compliance in Vermont, we think is quite good. So as much as we sort of talk about trust, it appears as though businesses are doing a very good job of, you know, trusting or whatever. We've entrusted our tax system to good stewards, I think. But there are exemptions for groups and goods. So there are organizations that don't pay the sales tax. The big one is 501c3 organizations if they have sales less than $20,000. And a lot of people think about 501c3 organizations, just nonprofits, but nonprofits is a huge term in general in tax world. It means hospitals, it means almost everything medical related in the US. Trying to think of other big 501c3 operations, but all the way down to, you know, your community little, you know, food shelf. So they're exempt if they have under $20,000 in sales. Federal, state, and local governments do not pay the sales tax. They have exemption certificates. And then we have purposes and goods exempted usually to make the sales tax more progressive. So we're exempting items that lower income people tend to spend a greater portion of their income on. Things like clothing, groceries, medical products, all exempt from the sales tax. And sales tax generally, and most consumption-based taxes, so meals and rooms, gasoline, cigarette taxes, are considered to be progressive because lower income residents pay a higher percentage of their income on these types of goods, and therefore a higher percentage of their income in sales taxes. What's new in the sales and use tax? So the big thing that's been happening is internet and remote sales. Prior to 2018, the Supreme Court ruled that if you are an online retailer, if you do not have a physical presence in the state that you're selling goods in, you are not expected to remit sales tax, an actual physical presence. But that was defined as things like a warehouse, a delivery truck, sales office, anything. If you had any physical presence, you were required to. But you know, if you think about a state like Vermont, there's not, big retailers oftentimes don't necessarily have a presence. So Amazon doesn't have a warehouse here. Amazon prior to 2018 actually came into an agreement to start collecting in Vermont. But the Supreme Court changed its mind in 2018 and basically said, no, states can now collect from sales tax from remote vendors. This idea of economic nexus. So if you're selling into the state, you may not have a warehouse, but you're there more or less. It's just the way the economy works. And they cited things like Vermont and South Dakota, so that it's not a burden anymore as much as it used to be, because Vermont is a member of an agreement which sort of defines what products are. It said that states like Vermont and South Dakota have a de minimis requirement. So if you make less than $150,000 in sales in Vermont, you're not required to collect the sales tax. So the Supreme Court basically said, well, we're not punishing these tiny remote retailers anymore, because most states just have these de minimis requirements, and they're often in the agreements. Compliance is a lot easier. There are companies set up that help collect sales taxes for companies. We're in a modern time. They say that old physical nexus rules out the window. Big deal in sales tax world. But I would emphasize that it wasn't as big of a deal as you might expect, because a lot of places, just a lot of big online retailers had presence in the state. Think Walmart, Home Depot, Costco, the store here. So they were already collecting, but things like Amazon, eBay, Etsy, big deal. So we estimated back in the time that we received about $20 million just from that Supreme Court stroke of the pen. So it's a big deal. And the bigger deal, I think, is proven to be a real boost to the sales tax is what we call marketplace facilitators. So a marketplace facilitator is something like Amazon or Etsy, where they are just essentially what they call a platform, where vendors list on the platform. What Vermont's and other states statute said is that the vendor, if you make less than $150,000 in sales, then you're not required to collect the sales tax. And what Amazon was saying, or Etsy and eBay, for example, was they'd say, well, we don't have to collect the sales tax. Who needs to collect the sales tax? Individual little bitty people on our platform. And a wave of states essentially said, no, that's bogus. You are the vendor. You process the payments, you do the advertising for these people. You are required to collect the sales tax. That was passed in 2019. We were one of the early movers on this type of law. You see a lot of it in tax code, marketplace facilitator laws. And we said, basically, if you are acting as a marketplace facilitator, you have to collect the sales tax on behalf of the vendors. So huge deal, because Amazon, biggest online retailer, only about 40% of their sales are directly by Amazon. The other 60% is from marketplace sales. So we're missing a huge chunk of money from places like Amazon, Etsy, eBay. And we think that I think we originally estimated was $15 million, just that change. And I know for a fact that was well underestimated based upon the Department of Taxes. So marketplace facilitator law was very important, and moving on to the next point, very timely, because the COVID-19 pandemic really changed how people started buying. So goods consumption, as I said, people were staying at home and buying stuff like home improvement, computers. People were not going out, traveling, eating at restaurants. So they were spending all their money on goods, which means we were getting a lot of sales tax. But the key thing is that a lot of this was happening online. And so e-commerce prior to the pandemic, we estimated to be somewhere in the 10 to 15% range of total sales. We think it's now about 35% just over the course of the year. And you see states that didn't have marketplace facilitator laws in place absolutely scrambling to update their laws and get on board, because they're just missing out on so much sales tax revenue. And they need it during those really dire times that were sort of circa April 2020 to August 2020. But again, a lot of this is driven by federal fiscal stimulus. We had bonus unemployment, putting money in people's pockets, multiple rounds of federal stimulus checks into people's pockets. Disposable income during the pandemic rose to record levels. So a lot of people spent that on durable goods, big expensive goods. And it was really hard to get a washing machine during the pandemic, probably still is. So those things are big items, big sales tax things. And so you see that we collected just over $500 million, which is $75 million more than any previous fiscal year. A big year, but there's a lot of uncertainty about what's going to happen with sales tax once we reopen. Will we see people continue to purchase goods? So one thing is we still have a ton of disposable income sitting out in the economy. People still might be buying stuff, or will we see more pivot back to services? People have been pent up. They're going to start going back to restaurants and traveling a lot, and we'll see sort of a drop back down to where we were before. So it's kind of, an outstanding question about what's going to happen there.
Perhaps I'm remembering wrong, but there have been times before where in Vermont, we've had a day where there hasn't been sales tax collected, right? Is that?
Not in my recent memory. We haven't had sales tax holidays in Vermont. A lot of states have sales tax holidays. I think some states in the pandemic have put in place sales tax months as well, holidays. So, but in my time here, we've never instituted a sales tax holiday. So maybe it happened in the past. I just can't remember.
Yeah,
I think it was the Great Recession the last time it happened.
yeah.
Isn't there something though in the Connecticut River corridor?
Something there, like a sales tax holiday.
Not holiday, but there's something within 5 miles of New Hampshire where there's no sales tax.
Oh, I mean, I don't know if you're referring to this or not, but there is sales tax, there is no sales tax in New Hampshire.
Right.
So if you buy something in New Hampshire, you're supposed you're supposed to pay the Vermont sales tax and they send it.
There's
Is
some,
that what you mean?
no, there was something in the last year or two. It doesn't matter. I don't remember.
Yeah, I mean, maybe we're talking about use. That's the other thing I'm not talking about a lot here. Is the sales and use tax. The use tax
Yeah.
is for stuff like New Hampshire, where if you go buy a washing machine in New Hampshire, you're bringing it back to Vermont, you are liable for the Vermont sales tax on
Yeah.
that. Compliance in Vermont is the highest in the country, but still it's 15% or lower, we think. It's not very much, $3 million a year in use tax. But in the past, we've done as a way of sort of getting around this remote sellers thing, because if you recall, before the Supreme Court decision, if you were buying remotely, and there was no physical presence, you weren't paying sales tax on it, but you were still liable for the Vermont use tax under law. And so one way that states tried to sort of get at this money was to really beef up use tax compliance. I think a couple of years ago, the Department of Taxes sent out a letter to Vermont taxpayers saying, have you bought anything online, not paid sales tax? You probably owe use tax, or based upon your income, we think you owe more use tax than you're putting on your income tax return. So we've seen a big jump in use tax, but it's nowhere near what we actually receive now that the law has been changed over. So, but yes, so New Hampshire, there may be something like a use tax agreement amongst the state, but I'm not aware of it. So the final big tax we're going to talk about is the corporate income tax. So what is it? So this is often a big confusion amongst the corporate income tax. People think that just the corporate income tax is the business tax. It is not. It is small, but it's the business tax that not very many businesses pay. So there are two types of businesses in tax world. A C corporation, which is a larger business, typically has 100 plus shareholders. It's oftentimes listed publicly on an exchange. It drives money from public markets. But the key thing is that the profits of the corporation accrue to the business. So like if you are Amazon, you make $100 billion. The $100 billion is the profits of Amazon Inc. And the second type of business is what we call a pass-through, is where the profits get passed through to the shareholders or the owner of the business, and then they pay a tax on those profits on their personal income tax returns. So if you heard of things like S corporations or LLCs, they're usually smaller businesses. But the way it works is that you might have, say, 10 shareholders. They might say, we made, let's say $1 million a year. Each person gets $100,000. And they take that and they put it on their personal income tax as business income, and they pay the personal income tax. A sole proprietor is another example of pass-throughs. All the profits of the business get passed to the personal income tax or business income. But the corporate income tax is only on the income of a C corporation, not on those pass-throughs. And the key point is that most businesses in Vermont and in the US are pass-through businesses, not C corporations. C corporations tend to be larger businesses, multi-state businesses. I always joke with my wife that you look at the businesses in, Montpelier, any town in America, almost all of them are going to be pass-throughs. Restaurants are almost always pass-throughs. Law firms pass-throughs. Even larger businesses. You might think of a small manufacturer. Maybe have 200-300 employees. They can structure themselves as an S corporation and pay the owners of the company or the shareholders will pay on the personal income tax. So want to emphasize that this tax is only on C Corp. So it's the tax on the net income, which is a fancy term for tax for profits of the business. How do we treat multi-state businesses? Taxable income, the net income, is determined by a formula using property, payroll, and sales. So the way we determine what portion of your income is based in Vermont is basically asking how much payroll do you have in Vermont as a share of your total company, how much property as a share of your total company's property do you have in Vermont, and how much sales in Vermont as a share of your company-wide sales do you have in Vermont. And essentially we take that formula and we come up with a number, an apportionment percentage, and that's what we tax them on. So for very large companies, that apportionment percentage might be something like 0.1%, but at 0.1% of a $5 billion business is still a lot of money. And then Vermont requires what's called unitary combined reporting. And so what that means is that we require companies, the way companies often structure themselves, they have a parent company and multiple subsidiaries that operate in different states. What Vermont says is that the net income that we're going to be looking at is the net income of the parent plus all of the subsidiaries, even though subsidiary A might not operate in Vermont. We say basically everything is considered part of Vermont. So a unitary combined return is a Vermont tax return for corporate income tax. It's part of a larger company. So what you might have is, say, company for a Vermont subsidiary is the filer, but on their net income, it's reporting the income of the entire group of companies. And then you have not combined returns, which are basically the subsidiary is the only company, or the company is just one entity. So unitary combined returns are about 13% of total corporate income tax returns, and non-combined are 87%. So most of them are smaller, non-combined returns companies. What is the corporate income tax bracket? Is a marginal bracket, but basically what I tell people, it's an 8.5% rate, because the net income brackets there are so small. You hit 8.5% at $25,000 net income, not a particularly large corporation. Corporate income tax, how much do we collect? So corporate income tax tends to be a little bit more volatile from year to year. Corporations oftentimes will pay a big tax liability one year and then have negative tax liability the next. It swings around a lot. And we get our corporate income tax, a significant portion of it, from a very small number of filers. I'm talking less than 200 filers of the 14,000 that we get. Very top heavy. And that's basically an iron law of business taxation in the US. The vast majority of the revenue comes from a very small number of tax filers. We collect about $175 million a year in corporate income tax, but you can see how it just bounces around every year. But corporate was one of those, again, revenues that really beat the forecast this past year. So $51 million above forecast. It's about 7.2% of general fund revenue that year. In the past, it's been around 5 to 6. So it's growing. But again, next year it could be $50 million less. It really bounces around. So again, who pays the corporate income tax? Only C corporations, and most of the revenue comes from a larger unitary return. So this is a chart from our tax study from 10-year tax study from 2017. But you can see that we had 6,300 filers paying $11.3 million of tax, and 13% of filers paying 84% of the tax. So very top heavy. Another law of business taxation, so not just under corporate income tax, I won't say law, but one thing that's sort of well known in tax reform, that businesses, a good chunk of them do not pay any tax liability. And this is quite evident in the corporate income tax. And you probably have heard about this in the news. This is sort of starting to come out a lot. But example, in Vermont, we had 13,236 corporate filers in Vermont that year. And only about 3,000 of them had positive taxable income. So they reported an actual profit, which means only about 3,000 paid the corporate income tax as part of the brackets. So you're talking about, 75 to 80% that pay either no tax. They're not paying into the brackets. What we have in place is a minimum tax regime. So if you're a corporation in Vermont and you have zero taxable income, you pay a minimum tax of, but it's pretty de minimis. I think it's like if you have less than 2 million of receipts, you pay $500. And if you have greater than 5 million, you pay $750. Small amount of money. So yeah, for small businesses, less than 100,000 Vermont receipts, 1 in 10 of them are reporting profits. When as you get to some of the larger companies, just over half are reporting profits. So that's something that Democrats in Congress have started to go after. And a lot of tax world is talking about is net income the proper way to look at this? Because corporations' net income fluctuates from year to year. You have companies like Amazon that have a zero taxable income one year, a big number the next. Is it quote unquote fair that large corporations like that should be paying zero? Sort of an outstanding question. So some states, I know Ohio's the big one here, now for corporations pay a gross receipts tax. So basically you pay on your sales, not your profits. So what's new here? The Tax Cuts and Jobs Act, that's the federal tax return, or federal tax change in 2017, did a lot of corporate income tax stuff at the federal level, particularly lowered the rates from 35 to 21%. But they also made changes around how you treat the profits of foreign subsidiaries of a larger company. And so basically what they said is you bring that money back. A lot of companies will sort of claim that this money is to a subsidiary of a corporation based in Ireland. They say if you bring that money back, you won't pay the 21%, you pay 8%. So there's kind of an incentive for companies to bring money back. But what that led to was a big base inflation in Vermont for a couple of years, because companies were sort of like, okay, we'll pay the 8%. They bring back their money. It blows up the base in Vermont, because Vermont is like that tiny 0.1% sliver. If a company brings back $10 billion, we get a chunk of that, albeit a tiny chunk. But we were seeing big spikes in corporate income tax revenue in fiscal year 18-19 from this. Companies that weren't paying anything, but are paying very small amounts, and they were large companies, and we saw all of a sudden they were paying a huge chunk of money. We think that that's what's the reason behind it. COVID-19, again, we've beaten the forecast significantly. A lot of this we think is because of federal fiscal stimulus. A lot of people spending a lot of money are helping boost corporate bottom lines a lot. And we think there's this potential revenue bump in this year because of a change that we made to the tax law 2 years ago to market-based sourcing. So this is getting really in the weeds, but somewhat important. But in corporate income tax for the sale of intangibles, so services, or so think things like Expedia, selling travel services, Facebook, stuff like that. You have two choices. You can either say, okay, sales of a non-intangible are counted to the state where the product itself is made, or you can attribute the sales to where it's delivered. So if you think of, say, Expedia is based in Washington State. They make their product, the code and everything in Washington State. And if you're under what is called a cost performance style of attribution, that income that is made in Vermont is attributable to Washington because that's where it was made. Or you can be under a market-based sourcing regime and say, no, it's where the product was delivered. And so what we're sort of seeing, we think, is from companies that have not paying a lot, things like tech companies, finance, insurance, that don't have a lot of actual physical presence here. We're seeing more and more larger payments for them after this change. And we think that's because of it. Because before they were saying, take a bank, for instance, like, or not a bank, like, that's a good example, Quicken Loans, Rocket Mortgage. That product itself is originated in Detroit. And so they're saying, well, under cost performance, that's a Michigan-based income source. If a Rocket Mortgage is originated in Vermont, but under market-based sourcing, we're saying no, because it's a Vermont customer that took it, that income is based in Vermont. So we're seeing sort of a jump in that. So quickly, some other revenue sources. So we've talked the big landmarks, meals and rooms tax, another big one, 9% on tax on meals and rented rooms, 10% on the alcohol portion of meals served in a restaurant. We collected $143 million in fiscal year 21, but to give you a sense of, this is one of the revenue streams that has not hit its pre-pandemic level for understandable reasons, but it was $173 million in fiscal year 18. So we're well below what we thought, or well below what we were collecting. And beginning in fiscal year 20, 25% of those revenues go to the education fund, 69% go to the general fund, and 6% go to the clean water fund. So any change to the meals and rooms tax gets sort of sprinkled amongst the funds. Another big one is the cigarette and tobacco products tax. So $3.08 per pack of cigarettes paid at the wholesale level. 92% of the wholesale price for other tobacco products. So the big change here was that in 2019, we applied that tobacco products tax to e-cigarettes. And that has been a significantly higher revenue stream than we thought. I guess we've been sort of saying that it's good because we have a lot more money, but it's bad because it means that people are using e-cigarettes a lot more than we think they are or thought they were. So in total, tobacco taxes are about $77 million, and that's all general fund revenue. And another big one is insurance premiums. Something I didn't know, but when I moved here is Vermont is actually a very favorable state for insurance companies, particularly captive insurance companies. And they pay 2% per year on the gross amount of the premiums that they write in Vermont. And that's paid in lieu of the corporate income tax. So insurance companies here do not pay the corporate income tax, they pay the insurance premiums tax. We collected about $60 million of that. And that's all dedicated to the general fund. So this chart here, our table is essentially Tom Gavette's forecast from January 2021. But you get a sense of just all the other tax revenue sources in the general fund that are available. So we have, meal dreams. We also have a tax on liquor. We have a tax on beer. We have a tax on estates, things like that. I'm not touching on those today, but if you have other questions about those, I can follow up sort of after. Yeah.
On the insurance, so since they're only paying 2% per year instead of the corporate income tax, would we be collecting more money if they were paying the corporate income tax?
It's 2% on the premium written. So it's not necessarily profits. So it's difficult to say whether we'd be collecting more or less if we're on the corporate income tax, because premiums written is essentially here's how much we are insuring, whatever.
Like a Vermont Mutual or Union Mutual, typically when they write theirs, they're looking for like a 5% income piece there after they pay out their bills and other stuff. So 15% or 8% of their 5% is a lot less than 2% of their 100%.
Yeah, but let's say there's a disaster, right? And insurance companies have to pay out a lot of money in Vermont, then their profits in a given year might be negative, a lot. And so it kind of depends on the year. A couple of years ago, I was asked to analyze whether banks right now pay in Vermont, if you're domiciled here, you have deposits, you pay 0.0096% on the average monthly deposits in your bank as a tax, the bank franchise tax. And I was asked a couple of years ago to estimate if we switch them to the corporate income tax, we make more money? And the answer is no. We are getting more banks from the bank franchise tax than we are from corporate income tax. And it would be something like anywhere between $5 and $10 million revenue loss if we did that. So, yeah.
Insurance change, that almost seems like a industry specific change from income based to a receipts based model.
I guess you sort of characterize it that way. It's sort of a receipts based tax because it's on premiums.
Right.
So yeah, it's different than an income tax. So we were past the Tom Gavette table. I guess this is part of the presentation I think Chris directed me to a lot. So here are some hot topic revenue ideas that I've done some work on. The first is cannabis tax. I get a lot of requests from legislators and the public on, well, how much can we get if we tax cannabis? So, and as everyone in this room is probably aware that S54, I can't remember what act it ended up being, but Vermont has legalized the sale of retail cannabis. And our estimates are we think that sometime in fiscal year 23. So still kind of a, shaky timeline. We don't know exactly when the first sales will be happening, but fiscal year 23 corresponds to calendar years 22 and 23. So it could happen in late calendar year 22 or early calendar year 23 is sort of our guess. But this was the estimate of revenue that we thought we could collect from cannabis sales. And this was based upon a model that myself and the tax department put together, but also cross-referencing what the other states have collected. So there's a chart in the fiscal note that essentially compares, if you scale other states down, their population to what ours is and what their revenue they collected, this is essentially more or less pretty close to what. So you might hear numbers like, oh, Michigan collected $300 million of cannabis tax. That's because Michigan has 15 times the size of our population. These are our revenue estimates. So you're talking somewhere between on the high end, once the market we think is fully online at fiscal year 25, $13 million on the low end and $25-ish million on the high end. We could be way off on that. JFO misses on estimates all the time. That's not something that is crazy. These are, I would just say that if we do beat it by a lot, it'll be because Vermont cannabis users are a lot higher than any other state. Because again, we based a lot of our estimates.
We already know that.
know that.
Well,
Graham.
we've already accounted for that in our model, but it would be it would be well above what other states had done. So even Colorado, right? So like in that chart, we sort of compared what Colorado's money would be in Vermont terms with the same tax rate, and it's about in this range. So I think it said something like, if we end up on the low end of this range, we will be something like, I think it was Washington, which had a really rocky outroll of their marijuana market. If we're on the high end, then we'll be something like Colorado. And Colorado being known basically as the first state to do this. Nowadays, I think I saw the latest numbers, like 13 or 14 states have legalized cannabis sales. Maine being the newest one in New England. Massachusetts has been selling for the past 2 years or so. So the first mover advantage is not there anymore, like it is for Colorado. Sports gambling, yeah.
One question on that. So as currently in statute, would these revenues just go to the general fund? Or similar to the?
Great question. No, not all of them. So there's two separate taxes here we're talking. We're talking about a 14% excise tax, which is what is on the sale of cannabis. Plus we're applying the 6% sales tax because we consider this a tangible piece of personal property. 6%, that 6% piece goes to the education fund. That's just the normal sales tax regime. On the 14% tax, 70% of that is dedicated. I think 70% is dedicated to the general fund and 30% goes to a substance misuse and prevention fund. I think that substance misuse and prevention fund is capped at 10 a year. So any amount over that would go into the general fund. There's been a lot of cannabis stuff moving, as you guys know, and that it's been a long slog.
15
So
years?
there's so many things in my head remembering what exactly actually passed. The next biggest one I hear a lot about is sports gambling. So we have not done a formal estimate on how much sports gambling, and a lot of it depends on what gets put into place. A lot of states have a ton of different regimes. Some people essentially operate like a liquor control model where you have a sports book and they take the bets, and whatever money they make, they send a chunk back to the state. Other states will have essentially a tax on the gross receipts of the sports book that is operating in the state. So there are lots of different models here, lots of different tax rates. We haven't formally done an estimate on this because there has been a bill, but it hasn't really moved anywhere yet. So, but there is a study coming out in October by JFO and Ledge Council that is looking at the issues and putting some money around money parameters, what was collected in other states.
Just curious, do we know what our sister state next door did? How did New Hampshire do with revenue?
I don't know what the number is. I'm trying to remember the regime. I think they did a sort of standard 10%. I think it's 10% on the receipts of the sports book. That's their model. And I think, so this $2.5 million figure you see here was in the administration budget proposal last year. And I was told that was based upon a scale down of New Hampshire's experience. So I don't know if you were involved in that.
So I think, so New Hampshire, I mean, they got the contract with DraftKings, right? And DraftKings and New Hampshire. So New Hampshire didn't set up an infrastructure. It was like DraftKings infrastructure. And then they share the revenue. I think it came online in like January 2020. And then, there were no sports for a long time. So there was that issue. But I was trying to get that same question myself. It seemed like maybe the revenue was like 3 to 4 million in a high month for New Hampshire. But they also say that, 40 to 50% of their sales are people from Massachusetts coming up to go to New Hampshire to put. So it's hard I think it's going to be hard for this study to determine that number.
Yeah, we'll see. But there are just other factors at play here. So we have New Hampshire right there in the border. But the other thing is Vermont's a quite aged population. And so you might lower the actual amount of estimates going on because those people don't tend to gamble as much, particularly on sports events. And so I think that was based, so the numbers I had seen from New Hampshire were higher than 2.5 million a year, but I think rightfully the administration was conservative and lowering it down. But the sort of message I would convey here is we're not talking huge dollars here. We're not talking a savior for general fund problems, particularly in the size of dollars that you guys are talking about. Not anything really. The final one that I've done a fair amount of work on is what are called high income tax surcharges. And generally what I've estimated on these are essentially a simple surcharge that applies directly to AGI. So we don't have to worry about any of that standard deduction or personal exemption or capital gain stuff. It's directly on income. So very sort of simple 1 to 3% surcharge on incomes, on the value of the dollars over a certain amount. I've done many different iterations of this, but here are 3 of them. So imagine a 3% surcharge rate on any dollars of adjusted gross income over 300,000. We preliminarily estimated that was about 60 to 70 million a year. 1.5% tax rate on AGI over 150, 30 to 40 million. 3% surcharge on AGI over 500,000 is about 40 to 50 million a year on a tax rate like that. So you're talking some pretty serious dollars there, but I would lay down some considerations for this committee and for legislators who have thought about this. First is as I've talked about, the personal income tax is already quite top heavy as it is. Doing this you'd be stacking another 30 to 60 million dollars on top of that very small. For 1% top 1%, we're talking about somewhere around 3,000 to 5,000 taxpayers of the 320,000 resident returns. We get about 380,000 total returns a year. 500,000, you're talking, anywhere between 1,000 to 3,000 taxpayers. So a very small share that you're relying on there. And the very progressive systems, especially at that level, are very prone to volatility because of things like capital gains. A lot of the people who are making money up there, sometimes, I think on average, half of their income is from capital gains, and that stuff just bounces around a lot. It's unpredictable. So these numbers you see here, I'm putting a range around them, but it's plausible that, say that 60 to 70 million, that could come in at 40. And I wouldn't blink an eye and say, okay, that sounds about right. I go to revenue conferences every year, and at least one a year is like, here's how we try to figure out how to forecast capital gains. Turns out we can't do it. So it's really tough to do. The other considerations, I'd say that if one of these were put in place, only 2 to 3 states would have income tax rates that would be near that level. And at some of the income levels here, Vermont would be the highest income tax state in the country. California notoriously has high income tax rates, but their highest rates really kick in at like $10 million of income, really high stuff. Hawaii's, I think, is probably the high. If I were making a judgment call, it's probably the highest income tax state because they're, I think they're like 9 or 10%. It kicks in at like $200,000. So I think when I did these.
Hawaii's on an island, 3,000 miles from another state.
It's true.
I mean, they don't have a border with New Hampshire.
People can move very quickly.
So I think when I did this, it was something like if you did the 3% on AGI over 300,000, Vermont or Hawaii would be higher than Vermont, up to 300, and then between 3 and 5, Vermont would be the highest, and then after that, California would be the highest. So it kind of depends on how much income, but you're talking about a sort of select group of states there that have significantly different economies than Vermont, significantly larger, I would say. And then finally, fiscal and monetary policy pay a huge impact on these groups. So I mentioned earlier, tax changes, right? If there's a change in tax rates being proposed, you see a bunch of high income people realizing capital gains in one year, and then you had nothing the next year. You see shifts of income all over the place. You'll see things right now, we have really low interest rates, so high capital gains. But what if the Fed starts to increase interest rates? You might see asset prices fall a lot, and therefore capital gains just completely fall off a cliff. So these do raise a fair amount of money, but I would say it's not sort of an easy, well, why haven't we done this already? There's lots of considerations, not to mention things like we have a state, less than 100 miles away that doesn't have an income tax at all.
So we did have an attempt to amend the bill that created this task force to add a surcharge. Did not pass the House. So the one thing to keep in mind is political feasibility of doing a tax increase. You know, whether the legislator would support it or the governor. So that's something to keep in mind.
So we are, I'm realizing that it's 12:15 and.
We're having so much fun.
And so I don't know how much you have left, but I think these are important. And so if people are flagging here a little bit.
Are you
Are
able to
you-
come back at 1 to finish your slides and questions?
Let me just double check. I may have a meeting. I cannot be here.
Okay,
So I have a time constraint about 12:30, so.
well, let's see if
Then
we can
let's-
cruise through then.
And then let's go till 12:30.
I will try to give this the quick treatment, although I do think it's important. So the
Yes.
last thing I'm going to talk about here is tax expenditures. Yeah.
One more thing on the revenue, on the surcharge. Did JFO do an analysis on this? Because that might help us.
Did not do sort of a formal fiscal note. A lot of these were done in basically on floor amendments. So I was essentially giving preliminary numbers so that people could have information on the floor. I do not have formal estimates of these things because there are a couple bills out there that I've given estimates or informally, but none of them have moved in any of the committees. So I haven't written a fiscal note just yet. Yeah.
Now we have more to get through just before moving on. Do you have information that you could get to us about taxpayer migration in and out of the state?
I 2 summers ago wrote 2 issue briefs examining that question. I can send them to you. The bottom line is that we did not find evidence of taxpayers moving in and out of the state because of tax rates. In fact, our biggest problem appeared to be amongst taxpayers with lower middle income that were aged between the ages of like 50 and 65. Our best strength was actually relative. We've lost a fair number of taxpayers over time, but our strength was amongst higher income taxpayers and particularly young higher income taxpayers. So I can send those 2 issues.
That'd be great.
Yeah.
Thank you.
Okay, so tax expenditures. These are basically statutory provisions which reduce the amount of revenue that would otherwise be collected, and they're usually done to encourage some sort of activity or advantage some sort of group. So example of tax expenditure is tax credit or deduction. So the earned income tax credit reduces the revenue available in the personal income tax. Social security deduction, where we've identified seniors as an area where we want to reduce their tax liability. So we put that in the statute, but it lowers our revenues. And then there's exemptions from the tax base. So example of that is clothing being exempt from the sales tax base. We don't tax clothing. Every 2 years, we have to estimate how much these cost the state. So that's what these 3 charts show you. So on the personal income tax side, we estimate that personal income tax expenditures are about $315 million a year. The vast majority of that is the Vermont standard deduction and Vermont personal exemption. I kind of say those are more or less mechanical types of tax expenditures, but they're technically, but they're not. The group is that they favor are so broad that they almost categorize it's just sort of a tweaking of the tax policy. So the real tax expenditures, I would say, are the earned income tax credit, the capital gains exclusion, the Vermont charitable tax credit, Social Security exemption, others. So you can see the earned income tax credit, the largest one that we have. Capital gains exclusion between $15 and $20 million a year. Charitable tax credit about 9 to 10. The Social Security exemption, I like to highlight this one a lot because Vermont's aging population makes this one grow really fast. So when I estimate this is fiscal year 2019, it was put into law in fiscal 18. It was $5 million then. It's $5.5 million in fiscal year 19. Preliminary, I've estimated about $6.5 million this year. So it's growing about $500,000 a year or more because more and more people, A, are retiring, aging population. B, the people who are on Social Security now have had higher incomes than the ones before, and so their Social Security checks are higher. And so the amount that we're exempting is higher. Sales tax exemptions. I mentioned there are exemptions aplenty here. $267.8 million of sales tax exemptions. Right? We collect about $500-ish million of sales tax. So you're talking about additional 50% we estimate Some of these we just can't estimate, we have no data. And these are estimates, so they're not hard data. But groceries is the biggest one, about $90 million a year. We think we're not collecting by not taxing groceries. Energy purchases for a resident, so any propane, fuel oil, electricity that you buy for a resident is not taxed. Clothing and footwear, another 33 million. Medical products, 54.8. Agricultural inputs, 16.9, and then a slew of others at 34. So, pretty big dollars, but a lot of those are put in place policies by the legislature to make the state tax less regressive. And then amongst the property tax, we estimate about $94 million of expenditures. This one is a little bit squishier because for properties that are tax exempt, it's not like the appraiser goes around and appraises them every year. They're like, well, why do we need to appraise a church? Never taxed. So take that with a grain of salt, but the big ones that you see are UVM and the state colleges, about 20. Private colleges, so the big ones there are Middlebury and Norwich account for about 14 of that $18 million. Just those two universities account for the vast majority of the private colleges. Pious organizations, that's churches, but also things like orphanages run by pious organizations. Private/public schools. This one was new to me when I did a review of this the property tax expenditures for public, pious, charitable organizations. A lot of these are for private or independent schools. So think Burton or St. Johnsbury Academy. There's one up in St. Albans. I'm trying to remember. But yeah, $6.7 million. Hospitals, $15 million a year to the state. So the big one there being UVM Medical Center, but also any other hospital. They are all nonprofits in the state, so they do not pay. And then tax increment financing districts at $6 million. So
What is that? If I missed that, what was it? It's
tax increment financing districts. It's an economic development tool that allows for municipalities to essentially keep state education fund dollars to finance infrastructure development.
So basically if a town has $0 development in this area, borrows the money to develop an area and it goes on the tax roll for the 20 years of the bond, they can use all the tax revenue to pay off the bond. But not all of it, some of that still goes to the ed fund. And then the whole point is in 20 years, that all then goes to the ed fund. So the concept behind that is you don't get that economic development without that investment locally with that debt. And so it's still a net positive seen to the actual property tax. So while it shows an expense, I know in St. Albans, they probably added $70 million to the grand list in St. Albans City. So yeah, we might be eating $200,000 a year or a couple $100,000 a year in St. Albans. It'll look like a tax expense. That 70 million in another 10 years at this point will end up going into the full fund to pay for schools and other things that wouldn't have existed otherwise.
Yeah, that's I'd say TIF districts are one of the sort of more controversial things in the state. It basically centers around whether equal development would happen without the use of the education fund. Won't get into that, it's another day, but for the purposes of calculating these expenditures, and I have to present to the emergency board, the governor and the money chairs, this TIF district number every year. And that assumes what we're told to do is assume that all of it would happen otherwise. So it's basically the education fund. Again, I'm not going to get into that today, but that's what we estimated. And then finally, resources. If you have any questions, here are some resources that you can look into if you want to look into more tax stuff. And then you can always contact me with any questions. I appreciate everyone's.
Any questions, final questions for Greg? Thank you.
Thank you.
So folks, we're getting a late start on lunch, but I also don't want to entirely shortchange our afternoon conversations because we're going to need to bump Chris Roop's discussion to right after lunch. So can we reconvene at 1:15? So we do a 50-minute lunch break instead of an hour.